I'm Cynthia Rowland, and this is episode 152 of EO Radio Show. In this episode, I'm focusing on the things that charitable entrepreneurs need to know when launching a new charitable initiative and are considering whether fiscal sponsorship is the right way to incubate, that is, test and build a new idea, or a good short-term vehicle to run a time-limited charitable activity without going through the expense and timeline of forming and qualifying a standalone nonprofit organization. In this episode, I'll go over what the terms sponsored project and fiscal sponsor actually refer to and the legal context in which they operate. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. In my practice, I'm often approached by charitable entrepreneurs, that is, people with a new idea for a charity or a charitable initiative of some sort, or with big plans for a big impact entity, but they need to kind of test it out first. And the quickest way to do that is with what they've heard of is a fiscal sponsorship arrangement. This also can come up in the context of disaster relief or planning a special event. There's a whole variety of different ways in which someone comes to me and says, can't we just use a fiscal sponsor? So when having this conversation, I start with the founder's why. What is the reason for why a fiscal sponsorship seems to be a good option? Well, a fiscal sponsor, which is a convenient kind of catch-all term that refers to a 501c3 organization that's exempt and eligible to receive charitable contributions that are tax deductible. A fiscal sponsor is a legal entity that already is recognized as a nonprofit corporation and has its tax-exempt status with the IRS and hopefully all the states in which it's operating. These organizations make their platform available to a person, a group, or another entity by either a written understanding that is not legally binding. Typically, we refer to these as a memorandum of understanding or an MOU. Or in other cases, it is an arrangement that's set up in the context of a legally binding written agreement. So for founders, the practical question here to start the conversation is, we just want to fundraise under an existing 501c3 instead of forming a new nonprofit and waiting for recognition. The general idea they usually have is that it's faster, cheaper, and smarter to do it this way. Well, sometimes fiscal sponsorship is indeed faster, cheaper, and smarter than a new standalone entity. As I've mentioned, for a pilot project, for something that needs a super fast start, for something that needs back office talent that the entrepreneur doesn't have, yes, fiscal sponsorship can be a great way to get started or to start and complete a time-limited project. So let's now talk about the founder's decision framing. What is the founder getting, and what are they giving up with the fiscal sponsorship type of arrangement? Well, as I've alluded to, sometimes you can, in fact, speed up the fundraising when accepted as a fiscally sponsored project of an existing tax-exempt organization. The founder can start looking for and soliciting tax-deductible charitable contributions or grants from private foundations. That's often a very big driver. Through the support of the sponsoring organization that will take receipt of these contributions and will hold them for the purposes of the founder's project. The fiscal sponsor comes with administrative infrastructure. That is, they have the finance capability to file the annual 990 and all other tax returns. They've got the infrastructure to support an audit if audits are required. They have compliance processes in place already. They know how to get the receipts to donors efficiently. They may well have multi-state registration in place so that the founder can immediately start fundraising online by providing a convenient Donate Now portal. The fiscal sponsor often already has in place comprehensive insurance programs and risk management structures. And sometimes the fiscal sponsor can even provide some anonymity for the donors to these particular initiatives, because the fiscal sponsor's donors aren't going to be publicly known the way that they would be if the founder set up a private foundation, for example. So what does the founder give up in these fiscal sponsorship arrangements? And This is really important because this is often where the surprises come. It's important that the founder remembers that the founder's project is not a charity. It does not have standalone status as a vehicle for which donors can take charitable contributions. The donors are generally relying on the sponsoring organization status and systems when claiming the charitable deduction. The sponsor control in a fiscal sponsor relationship has to be real and not cosmetic. Even if the founder does the day-to-day work of the charity, the founder needs to assume that the sponsor will retain meaningful control over the funds, compliance with all legal and risk management functions that are necessary for the particular activity. And all of this is because the conduit structures create real risk for the sponsoring organization. And I'll touch on the sponsoring organization side of this equation in my next episode. For now, we're just really focusing on what the founder is thinking about. But it is important to keep in mind that the organization does need very real ownership and control over the activities. Which brings up another topic for founders to keep in mind in terms of what they're giving up when they go the fiscal sponsorship route. And that is they're giving up control over who they're associated with. The sponsoring organization with many sponsored project is kind of a one-for-all and all-for-one arrangement, where the activities of one project can taint the reputational risk of all the others and sometimes even the financial risk of the others. And similarly, if the sponsoring org's activities get it in hot water, all of the projects could be tainted, as well as the project funds. Another thing to keep in mind as a founder is that sponsoring organizations that have been in the business of sponsoring projects for a while will have layers of bureaucracy built into the way they operate their projects. They have to, because the sponsored projects do all manner of things. They can have a wide array of activities and risk profiles, and so the bureaucracy has to accommodate all of the ways that things can go wrong. So typically, the sponsoring organization will have an elaborate and detailed project handbook or project manual. And so it is within that bureaucracy that the founder's activities will have to be operated. So let's shift a little bit now to the other terms that founders are often aware of just through the grapevine when they start thinking about a fiscally sponsored project. And that is the three most common models that are referred to in practitioner taxonomy. They're not legal structures. They're not part of a statutory scheme, but they're referred to as Model A, Model B, and Model C fiscal sponsorship. Each of these approaches has a very distinct personality or a very distinct set of rules that they operate under. So let's talk about each of these models, the founder experience in practice, the best fit for the particular model, and typical gotchas or things that I wish I had known that founders will mention. I'll also touch on the fee structures and the documentation for each model. So Model A is what we often think of as a direct project or an internal program of an existing fiscal sponsor organization. The founder experiences that they are effectively running a program inside the sponsor. The sponsor itself is the employer of all the staff, signs all the contracts, owns the bank accounts, and owns and controls all project assets. It's a really good fit from the founder lens when the founder wants maximum infrastructure to be available and doesn't need or want a separate legal identity. The fee structure can be pretty pricey under this model. I see it often in the 5% range, sometimes quite a bit more if the project will rely on government grants, and that's because government grants come with a whole lot more back office bookkeeping and accounting. The documentation for a sponsored project is, as I alluded to earlier, typically a memorandum of understanding. That is, it's not a binding legal contract. It doesn't bind the sponsoring organization to anything with respect to the founder or his activities. And it has to be that way because the need for the sponsoring organization to actually control everything. And so the MOUs basically say, we control everything. They often say that in many pages, and they say that in policies and procedures and the handbook for how the project will be operated. And they will control, this MOU will say, we can terminate this at our convenience whenever we need to. And if you, the founder, want to terminate the arrangement, we'll consider it, but we can't agree to it in advance on any particular terms. So these are the typical gotchas for the founders. Founders, sometimes when they go into this without advice or diligence, they think that the sponsor is really just a conduit and it's the founder's program. It's really not. And that will become very clear when things go awry or the founder wants to exit the arrangement. Oftentimes also the sponsor retains the right to terminate the project if it's too small. Many fiscal sponsors have minimum activity in a sponsored project, sometimes to the tune of hundreds of thousands of dollars. These sponsored projects are very expensive to operate, and at a certain size, 5% of the revenue that comes in is just too little to cover the sponsoring organization's actual expenses and the headache of operating a project. So that's the Model A. Now, Model B is typically an independent contractor project. It's documented by a services agreement with either an individual or a for-profit organization, maybe an LLC or a separate corporate entity. In these cases, the founder sees that although the sponsor is the donor-facing charity, the operator's entity or the operator individually actually runs the activities under a services agreement. This works out well, for example, for a special event that a contractor might want to offer, where the special event has a charitable purpose and is intended to raise funds. Sometimes I also see this with film projects, because while the project may not be commercially viable, the individual filmmakers and people who are working on the project do want to get paid for their personal time, and they do see an avenue for raising private foundation or individual donor grant money. So that's typically what this Model B or independent contractor arrangement looks like. This is a good fit from the founder lens when operational independence is needed, but there is still a need to fundraise for charitable contributions or private foundation grants. This is, as I alluded to, it's documented with a very typical services contract, an independent contractor arrangement that is very specific about the fee that is payable and the cadence and deliverables for those fee payments. It has term and termination clauses. It would typically have requirements that the contracting party complies with all laws and pays its own taxes and maintains insurance, other things that are very typical in a services agreement. The disappointment for the founders come when they're in this arrangement and they see that there's a misalignment between the independence of the operation that they need and what the sponsor wants to see in terms of its ability to supervise the expenditure of the funds and control risk. The fee structure for Model B can be lower than what we see with the direct projects. I should say the fee paid to the sponsoring organization is lower. And that's because the insurance and risk management and employee risks, those are all still borne by the founder and his or her organization. So it may or may not actually be a lower cost approach to a project, but for a founder who already has an existing business enterprise, and this is a one-off project that will be funded through charity, it can in fact be lower than trying to manage the project through a direct project activity with the highest fee structures. So the next area or the next category to talk about is the Model C or pre-approved grant relationship. This one works really well when the project is going to be carried out by a separate nonprofit organization that is already on its way to applying for tax-exempt status or has a clear sight line to tax-exempt status. Here, this fiscal sponsor organization receives the contributions and then makes a grant to this existing other nonprofit organization based on typical grant agreement structures. This is a great fit from a founder's perspective when they're already on the path for creating a separate entity and have already incorporated and need to bridge that gap between the time that they want to start fundraising and start activities and when they actually have a fully functioning independent 501c3 organization that can take over the operations of the project. The documentation, as I said, is a grant agreement. There's nothing particularly special about these grant agreements. The details are typically in the proposal and the budget, matching the budget timeline for the charity grants from the fiscal sponsor with the reporting and deliverables timeline that the grantor wants to see in order to ensure the fiscal sponsor grantor that the charitable grantee is actually using the funds for the intended charitable purposes. So with that being said, that leads into the typical gotcha for the founder. The founder is going to have the typical grant maker discipline. It's going to look carefully at budgets, reports, disbursement timing, and its discretionary review of the effectiveness or the progress made by the independent charity. The fee structure for this grant relationship, fiscal sponsorship, can be lower in terms of what is paid to the sponsoring organization. But keep in mind that the separate legal entity grantee that receives the fund has to have its own tax and compliance infrastructure. So it's going to bear those costs directly. It will have its own employee insurance and board insurance requirements. All those things are still going to apply at the grantee level. So it may actually be somewhat more expensive than operating as a direct project because you have to bear all these costs for perhaps a small entity where the larger sponsoring organization benefits from economies of scale in financing and providing for contracts that cover insurance and other organizational-wide overhead expenditures. So let's turn from that description of the typical relationships to understand from the founder's perspective what the conduit risk is that the sponsoring organization faces and why sponsors often say no to things that founders think would be perfectly reasonable. Even though conduit risk is often thought of as a sponsor issue, the founders do need to understand it because it directly drives the sponsor behavior. It's helpful to keep in mind that the sponsor can't credibly fundraise and solicit charitable contributions and then behave as if it's a mere pass-through to the project or to the founder's separate entity. Virtually all memorandums of understandings for direct project activities underscore this control concept by requiring that the sponsor retains discretion and control over all funds, all assets, all intellectual property of the directly operated project, because they need to ensure that those assets are held and used, accounted for, and managed exclusively for the sponsor's exempt purposes. The conduit risk does differ a little bit depending on whether you're talking about a Model A, B, or C organization. With the internal program of a Model A, the conduit failures happen when a sponsor is calling the project internal, but allowing the founders to act like they control a separate organization. For example, by allowing founders to sign contracts with third parties to control funds or assets, where founders ignore sponsor approval processes, and where founders make representations on the website that suggest that there's a separate project leadership. For example, projects that hold out to the public that they have their own board and their own officers. Those are all red flags for a sponsoring organization where the internal program is creating a risk of conduit treatment. So in the next model, the independent contractor arrangement, the conduit risk happens when the sponsoring organization allows funds to be transferred to the contracting party, to the service provider, without meaningful reporting, with sloppy documentation and agreements that are inconsistent as to who the contracting parties are. In the grant relationship fiscal sponsorship arrangement, conduit failures happen when the sponsoring organization is automatically forwarding money to the independent nonprofit organization with weak controls. There might be weak review or no reporting. There might be fundraising that implies that the donors are giving to the separate entity rather than to the sponsor. Here again, sloppy websites, sloppy donor acknowledgments, things like that can create a real risk to the sponsoring organization that they'll be treated as a mere conduit for granting funds to another organization that they don't control. So let's take a look here at founder checklists for the most typical situations. So when we have a founder that wants to use fiscal sponsorship as an incubator for something that may later spin out into its own charity, here are things that the founder would want on their checklist. When the founder is considering incubating a project with a fiscal sponsorship, the founder needs to be very clear on the phase during which the fiscal sponsorship would continue. Is it just to test the programming and then spin off? Is it to build a donor base and prove demand? What are the metrics for when you think you will want to terminate the fiscal sponsor arrangement and stand up a separate independent charity to spin off to? The founder needs to think of these things at the outset because there are some real implications to the timeline and the understanding with the fiscal sponsor. Keep in mind that if you do have it on your timeline to stand up a separate nonprofit corporation and attain exempt status, there is a long lead time just to set up the entity, and then there's also a long lead time to spin off from the fiscal sponsor to this new organization. So keep that in mind. Your timeline might be as much as 2 years from the time that you start the process for creating the new co before you're actually able to end the relationship with the sponsoring organization. And keep in mind that the fiscal sponsors consent to a spinoff of an incubated internal activity. Their consent is absolutely required, and they can deny that spinoff request for any reason or no reason. Usually the MOU has some good faith language in it. And you may well have grant agreements that came into the fiscal sponsoring organization that restrict the funds to a particular charitable activity. So that would be helpful. But you still don't control the fiscal sponsor's timeline or discretion as to when and how they will spin off the assets to the new entity. And they will also almost certainly have a holdback of your funds to cover potential or contingent liabilities after the core of the project is spun off to the new entity. So for a founder that's considering using fiscal sponsorship to incubate an activity, here's some really key questions to ask at the beginning. First, what is the sponsor's policy on spinning off? How will it handle the transfer of assets, intellectual property, domain names, donor lists, and restricted funds? It's good to understand what the sponsor's typical timeline and approval gates are for granting out the project assets to the new charity and how it will deal with the expense of the spinoff. Many sponsoring organizations actually charge the legal cost of the spinoff to the project itself, which makes sense in the grand scheme of things. Who else is going to pay for that? But keep that in mind as you budget and plan for the exit strategy. So turning to the other type of typical fiscal sponsorship, that is a short-term charitable activity that just doesn't justify creating a new nonprofit. This could be done through the direct project, internal program, or the independent contractor model. The core idea here is to avoid the time, cost, and maintenance burden of forming and operating a new charitable nonprofit corporation for a project that will end in a year or two and won't last decades. The core risk here for the founder to be aware of when planning this is misalignment. Often the projects want real quick ability to raise money, spend the money, and carry out the activity, but the sponsoring organization will still need to protect its exempt status and its compliance with the rules for a charitable nonprofit organization. So the founder questions when considering whether to use the direct project versus a independent contractor arrangement for this quick turnaround, short-term nonprofit. Again, as with other arrangements, the founder is going to want to know the sponsor's spend policy. How are pre-approvals managed? What's the reimbursement policy? How difficult or easy is it to onboard vendors? The founder will want to know if the sponsor supports the type of operational tempo that you expect. Think about a special event. If it's got a timeline, once the date of the event is set, you're going to have a fiscal sponsor organization that is able to get the necessary insurance in place to rapidly turn around approvals on hiring the people involved in putting on the event and things like that. So be sure that the sponsor has done this before, or if they haven't, that they're willing to learn with the sponsored project and make it work. The other basic question here for your short-term charitable activity is, where do you need the employees to reside? Is it important that the employees actually be engaged by the sponsoring organization, or can the work be done by independent contractors or through a for-profit organization controlled by the founder? So now let's just talk about some overall diligence questions for the founders. Like any other meaningful business arrangement, each party should do their own diligence and their research on the counterparty to make sure that the platform provider, the fiscal sponsor, can actually meet the needs of the founders. Sometimes the main concern is just speed and cash flow, but that's really not where most of the problems come up. The first thing I would ask if I were starting a new project as a founder, when I talk to sponsoring organizations, I want to know how long they've been in this business. There's nothing like learning how many things that can go wrong in sponsored projects than actually operating a lot of them. So beware of the sponsoring organization that is doing this as a one-off favor for a founder and they've never managed a sponsored project before. It can work, but there's a big learning curve for everybody. Secondly, I would like to check references to existing projects and some projects that have successfully spun off. I would also do some checking to see if the sponsoring organization is involved in any litigation, whether any of its projects have experienced adverse publicity, because the reputational and litigation risk for all the other projects can be material to the new projects coming on. I would also want to read very carefully the Memorandum of Understanding and Project Handbook for a Model A direct project type of organization. As a practical matter, the MOU, usually a well-written MOU, doesn't go through all the policies and procedures because it's just too voluminous for a sponsoring organization that sponsors a lot of projects. But read that first before you get too deeply committed to going with any particular fiscal sponsor. You'll also want to understand the fee and service scope. What is included in the fee? Bookkeeping, donor receipts, HR, payroll, insurance, contractor review. Some of that stuff is separately priced, particularly legal services and any special insurance policies over which you as the project may have little control over who the sponsoring organization uses for those services. So be clear on that up front. You'll also want to understand the control points for prior approval. Sometimes the sponsoring organization wants to approve all public statements, websites, lobbying and advocacy activity, significant purchases, and almost certainly hiring. The hiring process will be controlled by the sponsoring organization, not by the project, when working through a direct project. It's also important to keep in mind that the sponsoring organization for a direct project, that sponsoring organization will own the name of the project, the websites, the content, the data gathered during the sponsorship, the assets acquired. All of that has to, by definition, be owned by the sponsoring organization, unless they're separately contracted out with a Model B type structure. If any of that laundry list gave you pause, it's really important to think carefully whether a direct project is a good fit or whether you need to go one of the other routes. Finally, do your homework on the expectations for your exit strategy and termination. Ask the sponsor what happens to any remaining funds and restricted gifts if the relationship ends either by mutual agreement or, as sometimes happens, ends because there's some sort of misunderstanding or unhappiness on either side with the way the project is proceeding. So one last thing I want to mention is for founders and anybody involved in the fiscal sponsorship arena. There's a recent Senate bill that was introduced in the United States Senate in February of 2026. Senate Bill 3942 is titled the Stop Proxy Organizations Nurturing Subversive Operations and Riots. That is the Sponsor Act. And it was introduced by Senator Cruz, and it's now sitting in the Senate Finance Committee. And it's intended to add a new Section 501S, that is S as in Sam, addressing the liability of fiscal sponsors for sponsored activities. It would apply where a 501c3 sponsor spends funds for a fiscal sponsorship and a charitable contribution deduction was allowed for the contributions made for that sponsorship. It defines the fiscal sponsorship for which this liability can attach is situations where the sponsor has discretion and control over the funds expended in the fiscal sponsorship. So the founder takeaway here is that even though this bill seems a long shot for becoming enacted, discussion of this bill can lead sponsoring organizations to tighten their intake criteria, especially for Model A. And sponsoring organizations may require more reporting, and they may avoid higher risk activities. So founders should expect that fiscal sponsorship may increasingly come with more diligence and more guardrails on the part of the sponsoring organizations. On the flip side, founders should take care to require that if they are going to work through a fiscal sponsorship, they will want some assurance that all funds contributed for their project purposes will be held as purpose-restricted funds to try to insulate the project from other activities of that fiscal sponsor that might have liability attached to it, either through this new Sponsor Act or just from under general legal principles that hold the sponsoring organization responsible for all the activities of its sponsored projects. So I'll close with this message for founders. Despite all of the red flags I've mentioned through the course of this episode, fiscal sponsorship is often an excellent tool for incubating new projects or for addressing time-limited charitable work. But founders need to pick the model that works best based on the degree of control, independence, and operational speed they truly need. and then choose a sponsor whose systems and risk management match the reality of the needs of the founder. In the next episode, I'll talk about key concepts for organizations that are considering operating as a fiscal sponsor and the traps for the unwary sponsor. Founders may want to listen to that one too to better understand all the risks that drive the decision-making by the sponsoring organizations. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Ferrella, Braun & Martell. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.